In this presentation, we will add inventory using our bank feeds. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. We're going to go ahead and open up our reports down below. We'll be opening up first, of course, the balance sheet. Going to change the dates up top from January to April 04/30/20. Then we're going to go ahead and run that report. Then I'll right click on the tab up top and duplicate it. Back to the tab to the left, we're then going to go down to the reporting and open up the P&L, the profit and loss, or the income statement. We'll enter the dates on this one just for the month we're on, which is going to be 04/01/20 to 04/30/20, and then we'll go ahead and run that report. Then I'll go back up top to the tab and duplicate that tab as well. So then we're going to go back to the left. We're going to go down to the banking section, and we're going to go back to our bank fees. Let's go ahead and close up the old hamburger on the top left. And now we're going to be considering this Fender. Fender is going to be a vendor, and that's one of the people that we buy inventory from. So this is back to that kind of inventory situation. How are we going to be dealing with inventory? If we're on a cash basis system, and if we have inventory, that's usually some area where we have to kind of deviate from the cash basis system, unless we're going to use, a kind of a just-in-time system. Last time we did that and we expensed the inventory as we purchased it. Now we're going to take a look at a different kind of method we might consider. So you'll recall, if we think about inventory, what happens is we purchase inventory, then it will be increasing the receivable. It'll be increasing inventory and asset account at the time of purchase and decreasing, let's say, cash. And then at some point in time, we're going to sell the inventory, and then we'll move it from the asset account at the point of sale to cost of goods sold, the expense, usually with an create invoice or create sales receipt. Now, if we don't want to do that, if we want to be more on a cash basis system, then one way we could do is like we did in the first month. We could simply expense the inventory when we purchase it, assuming we're going to sell it soon, expensing it to cost of goods sold, and that way we'll be on a cash basis system. Then when we record the deposit, basically the income, we'll record just the revenue side of things, income going up, and then the other side being the cash. So income and cash, and then we talked about how we might deal with sales tax last time as well if we have the sales tax involved. So this time we're going to say, well, what if we want to track inventory not in QuickBooks, but outside of QuickBooks, but still kind of have some system to track inventory? So for example, we might have some type of system where we have a just-in-time system. If we sold like a lot of guitars, let's say, people come in and buy a lot of guitars, or if you're in a store that has perishable items and you purchase items and then sell them, and then you might basically have them at the beginning of the day. You'd know how many you have, you count them, right, and then you'd sell them, and then at the end of the day, you can count them and determine how many you have left over, and basically determine then what your cost of goods sold would be. It would be the difference. You'd figure out the difference in some other format and not do it through QuickBooks Online. In other words, not put in the items into QuickBooks Online, but simply have some kind of system like a perpetual or a periodic type of inventory system where you count the inventory and determine what the cost of the inventory is at the end of each night, or at the end of each shift, or at the end of each week, or at the end of each month. And if that's the case, then when you make the purchases, instead of expensing them when we purchase them, we'll still put them into inventory. However, we're not going to put them into inventory items. We're not going to use inventory items. We're simply going to include the net total into inventory and then track the detail of those items in some other format, an Excel worksheet or something like that, so that we can then use a periodic inventory system, just calculating how much inventory has been consumed over the time period. So that would look something like this, right? We would go to Fender is going to be a part of inventory, for us a guitar, and we're going to say that it's a vendor here, and we're going to put it into the category of inventory. So I'm looking not for an expense this time, not cost of goods sold, but we're looking for other current asset and inventory account. So I'm going to look for an other current asset. This is the liabilities. We're looking for, let's just type it in there, inventory. I know it's in there somewhere. So I think last time we put it to this one, it's an other current asset account. There's two of them. That's why I say that. but I think it's going to the inventory asset account. So note that normally if you're tracking inventory, you don't put anything into the inventory asset account unless you assign an item to it. In this case, we're not going to assign an item because we're tracking the actual inventory items, the guitars, outside of the system. We just want to record it to the total account for purchases for the financial side. So I'm going to say add that. Let's then see what it looks like if we go to the balance sheet, close up the hamburger, and hold down control and scroll up just a bit. We're at the 125. Let's go into the checking account. So within the checking account, I'm going to then scroll down, and we're looking for that vendor, which is Fender. So here it is. Here's Fender. If I open that up, we're going to open up, of course, that expense form, just like all the forms that we've been looking at. And then if we scroll down, the other side then is going to the inventory account. Closing this back out and scrolling back up, going back to our balance sheet. The other side then going to an asset this time, not to cost of goods sold as we did last month, but then going to an asset account, and that one is going to be the inventory asset here. Selecting that 840, scrolling down, we're looking for this one, Fender. Now notice we have this increasing inventory, this Fender's increasing inventory. Now, so how does that differ from what we had before? Well, we have the increases before that are happening when we were using a different type of system, more of a full service, accrual system where we had expenses increasing or bills increasing. And then the decrease happens when we sell the inventory with an invoice or a sales receipt. So same process here, but if I go up to an expense prior to this, let's take a look at this expense, for example. We're still using the expense form, but it's a little bit different here because it's using this item up top, a product item. So a product item is going to be driving the tracking of the inventory. And that's going to still go to inventory, the inventory account. However, it's also going to have the tracking of inventory along with it. So as opposed to if I close this back out and do what we did down here and go to this item for the expense, notice here we don't have the item. It went directly to the account of inventory asset, as opposed to selecting an item down here, which would be still increasing the asset, but it would also be tracking the inventory item related to it. So if I close this back out, we're in the same end result then, and I go back to my balance sheet. We're in the same end result, holding down control, scrolling up just a little bit. We're in the same result in terms of the inventory asset increasing, but we don't have the detail. Let's take a look at another report just to get a better idea of that. If I go back to the first tab, open up the hamburger, and scroll on down to the reports. I'm a little scrolled in right now, so that's why it looks different than it had in the past. And I put in I want the inventory, an inventory report, inventory valuation summary. Let's open up the old inventory valuation summary. Closing the hamburger back up. And let's put this as of 12/31/20. Run that report. This would be a list of our inventory by guitars in this case. And if we did this properly, the end number, that 672, should be matching what's on the balance sheet. If I go back to the balance sheet and I go to inventory, it doesn't match. Why? Because we didn't assign an inventory item. We just directly hit the inventory without telling it what inventory item there is. So again, we can kind of do that, but then what we would need to do eventually is record the decrease in the inventory and the cost of goods sold. Normally that's done with a sales receipt or a invoice that we would create, but we're not using those forms to drive the recording. We're going to make those forms really easy and just record basically the sales side of them as opposed to the inventory and cost of goods sold side. Then we'll decrease the inventory on a periodic system. How? We'll do a physical count, just like we looked at. We could count the guitars at the beginning, count the guitars, add the purchases, count the guitars at the end, and figure out basically the difference. Figure out how much of the guitars were consumed through a periodic kind of physical count. Now with guitars, that would be a little bit more difficult. If we have items that were all the same, like if we sold some particular item, then it would be easier for us to do kind of an inventory count like that as well. Then we can find out the difference, and we would have to then adjust periodically, decreasing the inventory, recording the related cost of goods sold. How would we do that? Possibly with a journal entry. So we can go into this inventory ledger at the end of each night, at the end of each week, at the end of each month, figure out the decrease in the inventory with a periodic system, and then record that decrease, making the inventory what it should be, what we counted it to be at the end of that time period, and recording the difference to cost of goods sold, assuming that that difference is what we sold over the time period. So to do that, you would basically go into a ledger. I'm going to hold down, well, let's go back to the first tab. And then I would hold down Control and scroll down just a little bit to 100%. And you can go into the accounting. And you would then, I'm going to close the tab back up, the hamburger back up top. You would be going into the inventory asset ledger. And then you can record the decrease here. You could add a, let's call it a journal entry, I would typically call it. And then you could decrease the inventory. It wouldn't be affecting cash because it would simply be coming out of inventory and recording the other side to cost of goods sold. So then you're just making inventory correct as of the end of each day or week or whatever in accordance with your physical count and possibly some kind of flow assumption, first in, first out, average, weighted average method, or last in, first out, probably first in, first out, or weight. In any case, you would decrease that and make the ending inventory correct. The other side then go into cost of goods sold, and you do that on a periodic system. So that's one way you can work with the inventory without tracking the inventory, which does add a significant level of complications, but still record inventory on the books and then do a periodic system of recording and expensing the cost of goods sold as it's consumed, rather than just doing a cash basis and recording the cost of goods sold just simply when you purchase the inventory.